What is mortgage refinancing? When you refinance a mortgage, you replace your original home loan. The lender pays off your mortgage using the money from a new one, leaving you with just one loan that has different terms, including a new monthly payment.
What type of refinancing options exist? Refinances come in many shapes and forms. However, there are two main options. Number one, a rate and term refinance. A rate and term refinance allows you to get a different interest rate and or change the length of your mortgage term. For example, if market interest rates have dropped, then you might be able to snag a lower rate. You could also adjust your mortgage term to pay off your loan faster. Refinance from an adjustable rate mortgage to a fixed rate mortgage and more. Number two, cash out refinance. A cash out refinance lets you tap into the equity in your home by replacing your existing mortgage with a larger one. Through this process, you pocket the difference in cash and use it on whatever you want.
Why might you want to refinance your mortgage? There are different reasons why you might choose to refinance, such as locking in a lower interest rate. This is one of the most common reasons to refinance a mortgage. Getting a lower interest rate typically helps borrowers increase their cash flow and save money over the life of the loan.
2. Accessing your home's equity. You may need extra cash for different reasons, like completing home renovations or covering a large, unexpected bill. You might also use a cash-out refinance to pay down high-interest debts, like credit cards.
Changing your loan terms. Maybe you have an adjustable rate mortgage and want a fixed interest rate instead, or you'd like to extend or shorten your repayment period. Refinancing allows you to switch up the terms of your loan.
4. Removing a name from the mortgage. A refinance can be used to get rid of co-signers or co-borrowers on a mortgage, which is common after an event like a divorce.
How do you refinance a mortgage? Refinancing will be similar to the process you went through to get your current mortgage approved. Your refinance lender will consider factors such as your debt-to-income ratio, the value of your home, and your creditworthiness to make sure that you can afford your new monthly payment. You'll also need to fulfill other criteria, like having a minimum amount of equity in your home. These requirements can vary by lender, and the process typically takes 30 to 45 days to complete.
Here are some factors to think about before you refinance. Interest rates. Refinancing can help you save money when you're able to get a lower interest rate. But if the new rate is higher, then you may end up spending more overall.
Number 2, your credit score and income. If your credit score has dropped, then you might not qualify for the lowest interest rates. So make sure your credit is in a good place before refinancing. If you're doing a cash out refinance or shortening your loan term, it's also important to crunch the numbers to confirm that you can afford the higher monthly payments.
3. Closing costs. Like your original mortgage, refinancing will come with closing costs, which can run you about $5,000 on average, depending on the lender. And if your current loan has a prepayment penalty, you'll have to pay that on top of your closing costs.
Number 4, your break-even point. This is when you start experiencing the savings from refinancing. If you move or refinance again before the break-even point, then you'll likely lose money on the closing costs that you paid.
Refinancing can be a helpful way for homeowners to save money and reach other financial goals. However, it's critical to understand your options and all of the consequences, so be sure to weigh the decision carefully before moving forward.
If you've been considering a refinance, now you should have a clearer picture of what the process involves. Thanks for watching.